So this is our last topic, as we had said. Accounting for partnership. Be there. So in this class, before the new syllabus, and I have to mention this to clear some issues in regards to your past paper. Partnership, we used to cover 3 phases. Accounting for the books of partnership, where there is dissolution. Accounting for partnership, where there is amalgamation. So dissolution is where now they have opted to close off the partnership firm. Then amalgamation is whereby 2 or more different partnership firms joins together to form a single partnership firm. And the third one, which we used to cover, is conversion. Conversion of a partnership firm into a limited company. So after the revision of syllabus, they did away with amalgamation. Is no longer there. Also, they did away with dissolution. So the only part which is remaining for us is how to account for the books of partnership in the event of conversion. So we are only concentrating on conversion. So after we have done those questions on conversion, you will see some questions in your past paper on dissolution and even amalgamation. So don't be bothered. Don't be bothered with the dissolution and amalgamation in your past papers. We only concentrate on conversion. I hope that is quite clear. So even your examiner will not go past, the examiner will not go past conversion. So the notes are going to be very brief, very brief. You write there, the main concern, let's write, the main concern is on how to account for the books of partnership, is on how to account for the books of a partnership, on how to account for the books of partnership, on conversion to a limited company, on conversion to a limited company, full stop. On conversion to a limited company, full stop, full stop, full stop. And I send down there, during conversion, comma, a realization account, is prepared in order to determine gain or loss, in order to determine gain or loss on the values of the assets. gain or loss on the values of assets. Full stop. Full stop. Partners' capital accounts. Partners' capital accounts should also be prepared in order to determine partners' capital accounts should also be prepared in order to determine the capital balances, in order to determine the capital balances, for each partner. Capital balances for each partner upon conversion. Full stop. Continuation. The capital balances for all the partners. The capital balances for all the partners. Is considered to be the equity or ordinary, considered to be the ordinary share capital, is considered to be the ordinary share capital, in the new company. Full stop. So what happens during conversion? We prepare an account called realization account. So in the realization account, you close off all the assets there in order to determine whether you gained or you lost on the values of the assets. Then you also prepare partners' capital accounts to know how much is due to the partners. So the amount due to the partners, remember, it's just being converted. The same partners are the ones who are going to be the directors in the new company. So you determine how much capital is due to each partner. Then those capital balances, when we open the books of the new company, those balances are considered to be the ordinary share capital. So you aggregate, you sum up all the capital balances, then you consider them to be the ordinary share capital. Down there you say capital balances should be added together with the balances in the partners' current accounts. Added together with the balances in the partners' current accounts. Full stop. So we normally have current accounts where we normally record the current affairs, partners' salaries, partners' drawings, all those things. So we normally prepare partners' current account candle. Then from there, the balances which are there, you add it to the ones in the capital account. Then the total becomes the ordinary share capital. Let's avoid a lot of stories. I can see I have a question here, which I want us to check. November 2019, question 1B. Open that question. Open that question. So I hope everyone is there. Page number 45. I believe everyone is there. So allow me to read the question. Allow me to read that question. It says, Chanda, Pete, and Tender have been partners in a business for many years, sharing profits and losses in the ratio of 2:2:1, respectively. Okay. On 30th June 2019, the partners agreed to convert their business into that of a limited company to be named Chapete Limited. The trial balance extracted from the records of the partnership as of 30th June 2019 was as follows. So there was property at cost. So property was 60,000, of which 50 million was buildings. That means the difference is land. Plant and equipment, motor vehicle at cost, furniture and fixtures, provision for depreciation. So there was provision for depreciation, as you can see. Net profit for the year, trade receivable and trade payables, inventories, cash and bank, fixed capital accounts for Chanda, Pete, Tender. There is bank loan, current accounts, drawings, fines. Additional information, number one, the property, plant, and equipment in the partnership were being depreciated as follows. So depreciation was being charged, as you can see, building 2% on straight line. Straight line means you charge on cost. Plant 12.5% reducing. Motor vehicle 20% straight line. Furniture 10% straight line. Depreciation for the year ended 30th June 2019 had not been provided for. So if they are not charged depreciation, it means the net profit for the year is wrong. So we need to adjust the net profit for the year. Number two, the partners were entitled to an interest on their fixed capital balance at the rate of 10% per annum. No salaries were paid to the partners. The tangible and current assets were to be transferred to the new company at their fair values as follows. So the new company property will be transferred at 57, plant at 16, motor vehicle 95, furniture 35. The current assets and liabilities were taken over by the new company at their book values. So the assets and liabilities were to be taken over at book values. The purchase consideration amounted to 110 million and was settled by the new company through the issue of ordinary shares of shillings 10 each to the partners in satisfaction of the amounts due to them upon conversion. Required. So you are required to prepare what is called realization account, partners capital accounts, then opening statement of financial position as at 1st July 2019 for Chapete Limited, the new company. So before we go to realization and partners capital accounts, we have to adjust the net profit for the year. So we need to adjust the net profit. Once we adjust the net profit, we share now that net profit to the partners. Then after sharing the profit to the partners, we will adjust the current accounts. The profit salaries, they do affect the partners' current accounts. So we need to adjust the net profit first because it was wrong. Depreciation had not been charged. Once we adjust the net profit, we prepare now the partners' current accounts because we need those balances to go to capital accounts so that we can know how much is due to the partners on conversion. So any moment you realize during conversion that in the question there is net profit, even if there is nothing to adjust, that net profit, first of all, you share it to the partners in what we call appropriation account. Then once you share that net profit, you adjust your current account, then the balances in current account will go to the partner's capital account. So let's have a working there. You call it working one. So working one, adjusted net profits. Adjusted net profits. Adjusted net profits. So shillings are in thousand. So we want to adjust that net profits. So you'll start by saying reported. So reported net profits. What they have reported to us, check in the trial balance, they have reported 28,800. They have reported to us 28,800. Then you let depreciation. So you less depreciation. So depreciation, they say they are not charged. So buildings, they said in that note number 2, note 1, 2% on straight line. So 2% times straight line means of the cost. So buildings was 50. How much, or you will give me all the figures. So here, put it here. Then also they want us to depreciate plant and equipment. So plant, they said 12.5%. 12.5%. Reducing means on net book value. So you will take the cost of plant, which is 25, then you subtract depreciation, which is appearing in the trial balance, 13. That is on net book value. Help me with that. Then motor vehicles, they have said 20% on straight line. So straight line you charge on cost. Cost of motor vehicle was 12. You give me the answer there. Then F&F, furniture and fittings, they have said 10%. So 10% times straight line 4,000. So this one is 400. That one I can tell. Can you give me the 3 others? Give me all of them at once. Thank you. I can see the answers there. And that has been confirmed. 115. So this is 1,500. Then we have 24. Total, how much? If you add the 4. If you add the 4, what do you get? $5,300. So subtract. What do you get as now the correct net profit when you subtract? $23,500. 23,500. So this 23,500, you share it to the partners in what we call appropriation account. So down there you say appropriation account. Appropriation account. Appropriation account. So appropriation, what goes to appropriation? Maybe you have forgotten about this. It's something you did kitambo in the foundations of financial accounting. In appropriation, you check the benefits going to the partners. Was there interest on their fixed capital? Were they being paid salaries? Did they make any drawings? So you adjust those ones before you share. So in this question, I saw somewhere them saying that there's something I saw. In note 2, the partners were entitled to an interest on their fixed capital at the rate of 10% per annum. So you will first of all give them that interest, then you share the remaining profits. So interest on capital. Interest on capital. So we have Chanda Pete Tena. So Chanda Pete Tena. So they were at the rate of 10% on fixed capital. So 10%. Chanda fixed capital was 30. So times 30. This one is 10%. I've seen that one is 20. And this one is 10%. I've seen that one is 10. So it means this is 3. This is 2. This is 1. So total 6. So how much will be remaining when you subtract? So that is what we are going to share. So the remaining balance is 17,500. So I hope my board. I want to proceed the other side. So the balance which is remaining is 17,500. So 17,500. So 17,500. I know it is not very clear out there. I want to adjust my pen, but I hope we are following. So the 17,500 is what now you share to the partners. So you share in their profit and loss sharing ratio. So profit share, write down there, profit share. So profit share. Profit share. So profit share. Profit share. Chanda. Pete tender. Chanda, Pete, tender. They were sharing in what ratio? Profit and loss sharing was 2:2:1. So 2 plus 2 plus 1 is 5. So 2/5. 2/5. 1/5. So share the 17,500 in this ratio. Can you give me the three of them? Olivia ushafika huko 7735. 7735. So that gives you 17,500. That is nil. So we have successfully shared that profit. So mambo ya profit imeisha. It ends there. So what next? Why was I bothered? Why was I bothered with adjusting profit then sharing? Because I need my current account to be adjusted. Current account is normally adjusted with items appearing in appropriation account. Any item in appropriation must be taken to the partner's current account. So I need to adjust now the current account, then the balance in current account will go to the capital account later. So down there, you write for me, partner's current account. Because I have appropriation, I must do current account. So right there, partners current accounts. Partners current accounts. So chanda, Pete, tender, kila mtu akuwe na nafasi yake. So you write in full, I'll be using the initials, but write their name in full. So chanda, Pete, tender. Chanda, Pete, tender. So shillings are in thousands. I hope you have done that. So current accounts, go to the trial balance. Current accounts, all of them on the credits. So balance brought down. Balance brought down. 4280. I hope you are seeing those figures there. 4280. 3560. Then we have 2340 there. Then now, these people are entitled to interest, which we have just calculated. So any benefit to the partners you credit the current account. So interest on capital, 321. 321. There. They are also shared the profit. So profit share. profit share 7735. 7735. 7735. Then there were drawings. So drawings, you debit the account to reduce. So you say here drawings, 1580, 1170, 710. Simple as that. We are done with that account. There's nothing much which goes there. So the balancing figure, you will take it to the capital account so that we can determine the total due to the partners. So your balancing figure here, you pay to capital account BF, the balancing figure to capital accounts. So add this side, subtract the drawings. Tell me the three figures here, which we are taking to the partners' capital accounts. Give me the three figures there, which you are taking to capital account. So people are getting 12,700. So here is 12,700. Then we have 11,390. 11,390. Then we have 61,30. 61,30. Thank you. So those balances will go to their capital account so that we determine the total amount due to them. Ukishafika hapo, you can start answering the question like the realization and the rest. But I always prefer doing one more working goodwill. Whenever there is, you know, when you are converting, it's like it's a new acquisition. New acquisition. And on acquisition, from our group perspective, on acquisition, there is always that goodwill element. So I want us to calculate goodwill arising on the conversion. There is always goodwill which arises. So let's have the last work in here, call it goodwill. Call it goodwill. You know, when you're converting the partnership to a limited, it's like limited is acquiring the partnership. So how do we calculate goodwill? I just want you to tell me the formula from our group account. What is the formula for determining goodwill? What minus what? I want to see whether we can recall. I want to check whether we can recall our formula. What is the formula for determining goodwill? Only purchase consideration minus net assets Kinudia time. That is good. So you take the purchase consideration. So here you will say purchase consideration. Purchase consideration. Purchase consideration. We were given check note number 5. Check note 5. The purchase consideration amounted to 110 million. So purchase consideration is 110. Then you less net assets acquired. So less net assets acquired. So the net assets in this case, you take all the assets minus all the liabilities acquired at their taken over values. At their taken over values. That is what you need to understand. So assets acquired, assets is equals to, let's add all the assets acquired by this company at taken over value. Check note 3. Check note 3. The tangible and current assets were to be transferred to the new company at their fair values as follows. So property 57, plant 16, plus motor vehicle 95, plus fixtures 35, plus those are non-current. Then note 4, the current assets and liabilities were taken over by the new company at their book value. So these are just book value. Just check the way they are appearing in the trial balance. So at book value, trade receivables 18,200, inventory 25,300, cash 81,20. There is nothing else. Those were the assets. Please don't copy. Come up with any award, just tell me. We normally record how you acquired them when checking goodwill, the acquisition value. So current assets at the book value the way they were, but non-current they took at a different figure. So can you give me this total value for the assets first here? How much? Add all of them. Olive is giving 137,620. I hope it has been confirmed as well. 137,620. I confirm. Liabilities, you bring the liabilities taken over. So liabilities, they said as well that liabilities were taken over at book value. So just check the liabilities. Liabilities, the first one I'm seeing, it was trade receivable and payable, 14,700 for payables. Check payables, 14,700. What else can I see? Bank loan. There is bank loan of 18,000. 18,000. There were only 2. These ones are only 2. There is no any other liabilities. Bank loan and trade payables. 14,700 plus this should be 32. 32,700 if I'm not wrong. This is 32,700. So subtract. So this minus this is the net assets, which I'm going to bring here to get goodwill. So 137,620 minus 32,700. What do you get? How much do you get? 104,920. So this is 104,920. Subtract. Therefore, the difference is goodwill. That is how you calculate goodwill on conversion to partnership or conversion to a limited company. You take the purchase consideration, then the net asset. Net asset is the assets taken over minus the liabilities. So 110 minus that, how much is goodwill? Goodwill, Joshua, and the rest 5080. So this is 5080. Tunahitaji hapo mbele. I want to close now realization account. Realization, you will require all the assets. All the assets, all the assets, you will require them. You will require all the assets at their net book values, not taken over at their net book values. So before I go to that, because I know that Tushika hapo mbele, look for me this net book value of the assets, net book value of the assets in the partnership. So we need to check that because there are a lot of issues. So net book value, NBV of non-current assets in the partnership. I'm doing this because there was accumulated depreciation for the year, all those things. So for property, the cost was 60. 60 means it includes land, so there's no problem. The cost was 60 minus accumulated depreciation was 5. 5. So how much did we charge depreciation for buildings this current year? This current year, how much did we charge? You have it there, where we charged when we were adjusting the P&L. How much was depreciation on property? 1,000. Thank you. So minus 1,000, it means the book value 60 minus 6, around 54. 54. Then plant and equipment. Plant and equipment is 25 minus the accumulated. Accumulated, I'm picking them from here. 13 minus, how much did you charge for the year? How much was the depreciation charge for the year on plant? 1,500. So how much is the net book value? Net book value is 10,500. Then motor vehicles. Motor vehicles is 12 minus 48 minus, what did you charge? $24. So what will be the book value be? 24 plus that is 72. Is it remaining again 48? Confirm? Yes, 48. Then F and F. Tulikuwa nataka kupeleka hii kitu kufanyia hii working for realization because our time. F and F cost 4 minus accumulated 16. This one I remember you charged 4. So this is 2,000. Correct. So now let's prepare the realization account. Let's prepare realization accounts. So it's when we want to answer the question. But let's answer the realization, you can even start without those workings. So Roman 1, realization accounts. Realization accounts. Have that. So the partnership inafungwa, we are going to the new company. So close the assets as well. So in the ledger, assets are always on which side of the ledger? I want to see if you can recall that from your accounting. Assets in their ledger. Assets we normally record on which side of a ledger? Or yes, DR, root DR, yes. We normally record assets on the debits. So it means when we are closing this partnership, the assets books must be closed. How do we close assets? By crediting, because assets have a debit entry. So the double entry, when closing the asset during conversion, credit the assets, then debit realization account. But now you debit with the book values, not taken over. Taken over unaenda kunegotiate huko pengine. So you debit realization, hata usisumbue na vitu mingi. Just know realization is debited with the book value of the assets. So you bring the assets here, then you credit with liabilities. So there we go. So the assets, property at book value 54. Plant and equipment 10.5. Motor vehicles 48. F&F 2,000. Then not only non-current, all the assets. You know others, the current assets were at book value, so you just pick them the way they were. So receivables 18,200. Then inventory 25,300. Cash and bank 8120. So ladies and gentlemen around, realization, kama utaki stress kwa mtihani, you don't even have to go through those workings. Because which working did you require to post this? Mtu tu alikuwa ameanza. Alikuwa ameposta hapo mbele huko. Na tapita tu bado. Atakuacha leo kingangana hapo na workings. Mwaye kama watu wakiwa kwa barabara. Kuna watu wakijua hawana makosa na kuna police traffic. Akijua ana makosa bado anasimama anasalimia polisi, ndio anajua ana makosa. Na mtu anajua no wastage of time na ana makosa anapita hata ana biashara na polisi. So usikuwe na biashara na mambo ya workings. You know, with me I have to go step by step because what if my students will be taught to prepare an adjusted P&L current account. So I have to follow all those procedures because they can also be required. So in the event they are required, you know what to do. But in exam, we end up with realization. What you need to know is that realization account is debited with the book values of the assets, period. Higher. Then liabilities in the ledger, they normally have credit balances. So to close those liabilities, debit liability credits realization. So just know realization is debited with assets and credited with liabilities at their book values. So payables payables, 14,700. Then bank loan is 18,000. Then unaona hiyo purchase consideration ile wanatupatia. So purchase consideration you will debit maybe the cash book or whichever. When you receive, then you credit the realization account. So realization is credited with the purchase consideration. So purchase consideration, but not only this, all of them, because you will debit the new company naitwa Chapete. So you debit Chapete with that amount, then you credit realization. For purchase consideration, Chapete Limited, it was 110. So you credit there with 110. Then in case, though this one was not in this question, if a partner takes over an asset, you also credit in this account. So asset taken over by a partner. Taken over by a partner was not there. If at all it is there, you bring it on the credit side. So I want you to balance for me this account. Don't post, just tell me the balance is 200 on the debit or on the credit. But don't post that figure. So tell me that value, the balancing figure, the difference. Realization is over. Sawa, 780 on which side? It's appearing on which side of the realization? That balance should be on the debit. Okay. So 19,780 this side. So it is that figure is going to be shared by the partners for the end of the. So you come here and say you will close it to the partners accounts. So to partners capital accounts, that balancing figure wanajiita nani? Chanda, Pete, Tena. So Chanda will take 2/5 of the 19,780. Pete will also take 2/5 of the 19,780. Tender will take 1/5 of 19,780. Which one? So tell me the three figures. So you share that difference, you have to share to them. So tell me there, chap. But I'm really suspecting partnership to be there. If you rate me, I'll give it 95% chances. Doing the person. Of late, wajakuwa very keen, but kuna time partnership will not miss. So it should be there. Meanwhile, give me the three answers. So people have shared here 7912, 7912, so 7912, 7912, then 3956, 3956. Who has a question on realization? That is how you prepare realization account. Inakwanga rahisi. Debit all the assets at book values, liabilities book values get different share to them. If no question, let's go to the next. The next is partners' capital accounts. I want to delete this. So partners' capital accounts. Partners' capital accounts. So have that. Is this slide really necessary? No. Aye. So balance brought down. Balance brought down. Even before checking, I can recall. Really, can I recall? 30, 20, 10. That's why people wanaenda kuongea tena wanachukua capital wanaweka on debit. Capital should be credit unless dictated otherwise. So this is 30, 10, 20. 30, 10, 20. Good. Then current accounts. There are those balances you are given. Can you copy paste them there? The balances for current accounts. So current account, we adjusted, so we have to close it here. We want to know all those balances. Current accounts, what were the figures? Better here is 30, 20, 10. 30, 20, 10. Okay. So current accounts, what were the balances? The ones which we are saying to capital. Can you give me those figures? The ones you are saying to capital. 12,700. 12,700. 11,390. 6130. Thank you. Then on realization, the balancing figure we are closing to capital account, that is on the debits. So you credit capital account. Sometimes it can be on the credit, so you bring it this side. So realization, 7912, 3956, like that. I don't see any other entry which will affect the partner's capital accounts. So read for me this note, please. Read note number 5. Drawings brand. Drawings, we have factored it for it in the current account. Check current account. Current account, drawings goes to current. Unless there was no current account, you bring them to capital. But when you have both current and capital, drawings goes to current account. Thank you. So check note 5. The purchase consideration amounted to 110 million and was settled by the new company through the issue of ordinary shares of shillings 10 each to the partners in satisfaction of the amounts due to them upon conversion. So they gave them ordinary shares worth 110,000, and the 110,000 was to compensate their capital balances. So what that means, when you add, there is nothing else actually we are adjusting. When you add this plus this plus this, the balancing figure, which you will get here, when you add the 3 of them, it should tally with 110. If it is not 110, then we are wrong. We are wrong or there's something we have not captured. Because they were given shares to compensate their capital balances. So the capital balances are these ones here. So you come this side and say, ordinary shares. Ordinary shares. That is what they're supposed to be given. So you add, they are the balancing figures here. So can you post these balances? Then after doing that, we are going to add the 3, this and that, whether it will be 110. If not, then we recheck. So do for me that, then you give me like 3 minutes, I'm coming. Do the 3, then you tell me, do the 3 with particular figures, then you tell me whether it is balancing with 110. So balanced means it is in order, you know, there 50, 612, 50, 612, 39, 302, 39, 302, then 20,086, 20,086. So if it's balancing with 110, then it means we are accurate because those are the shares they were supposed to be given. This is their capital balance. At the let me pick Brian, Joshua, and Jacqueline. They are the people in the partnership. Then now they want to take it to a limited company. So the same Brian, Joshua, and Jacqueline are the same people who are going to be directors in that other company. So what someone was claiming as capital, that is going to be their shares in the new company. So the share from Chandler will be 50, 39, 20,086. But remember, in a company, directors, we don't mention them by their names. You just tell us ordinary share capital, one figure, 110. You don't have to mention people. So let's go to the final opening statement of financial position. So Chapete Limited, opening statement of financial position as at 1st July 2019. Have that. So non-current assets. Now non-current, the taken over values. Don't record the book values anymore. Taken over notes 3. So property was taken over at 57. Plant and equipment, 16. Motor vehicles, 95. F&F, furniture and fixtures, 35. Goodwill, 50, 80. Can you add for me those non-current assets? Thank you. 91,080. The good thing to the 91,080. Current assets. Current assets book value. Receivables. Inventory. Cash. And bank. So book value, they were taken out at book value. 18,200. Inventory 23. 25. 300. 81. 20. Bring it here. What I want from you is total assets. Total assets. How much is your total assets? Total assets figure is what I want. Yashingi has confirmed 142. 700. Yes. Then equity and liabilities. Equity and liabilities. Ordinary share capital. 110. So don't come and mention directors by their name under equity. That is not allowed. If you want, unafanya ile mnasema lifting, una lifting nini kwa company law. Lifting. Yeah, lifting the veil. Yes, so you don't mention directors. They don't have profit for now. It's just an opening balance sheet. So you don't bring profit. So now current liabilities, loan, there was bank loan. There was bank loan which they acquired. Bank loan was 18. Then current liabilities, the only current liability was payables. Payables on the credit 14,700. Full stop. So total equity and liabilities, it is balancing with that one there. Balance.
Little word.
Mute, Yeshua. 142. 700. Please, we have 1 minute. 1 minute is enough to show you. There is something wanapenda kuuliza, ndio kuuliza kwa hii swali. I want to do it. So 1 minute is enough for. Wamekuuliza the purchaser's account. Purchaser is the Chapete. So in case you are told to prepare Chapete account, this is what you do. Chapete Limited account. Of course, in the books of the partnership. So if you are told to prepare Chapete account, you come here and say purchase consideration. Purchase consideration. You invoice them 110. The purchase consideration was 110, which they paid by giving out ordinary shares. So ordinary share capital to wanajita nani? Chanda, Pete, Tender. So those shares, they were given in their capital account. I remember. We'll repair hizo figures. Let me just retrace them instead of disturbing you here. It was 50, 612. This other one was 39,302. And the other one was 20,086. 20,086. So in case you are going to prepare the purchaser's account, this is how the purchaser's account should look like. That's what it should look like. You know there? Is this to mean the balancing figure in capital account will always be ordinary share capital? A very good question. You know, is asking, does it mean the balancing figure in the ordinary share capital account, sorry, in the partner's capital account will always be ordinary? Yes, the answer is yes. In fact, there's a question we'll do somewhere. The examiner, part of required, you are told to determine the share capital to each partner, Evo. So when you are told to determine share capital to each partner, so share capital which is going to the new company, you simply prepare a capital account. So if they want the ordinary shares to the partners, you just prepare a capital account. The balancing figure in capital accounts is the ordinary share capital. So thank you for that. Maybe you could have passed me there. So in case you are required to prepare the purchaser's account, you debit the purchaser with the purchase consideration, then you credit with where they have been given shares. So when we meet in our next class, I want to leave you with this question. You can try it at your free time, then we'll meet and check. This is May 2018. For May 2018, question number, which question is this? Question number 3B, page 69. So if you get time, first of all, you go through this one, then you try that one out. We'll do it in our next class. Otherwise, thank you so much. You have a nice day and good week ahead. God willing, we shall meet on Friday. Thank you. You can log out.